back to your question about debt to income. Here's the equation. Debt to income ratio, and this is another calculation that lenders and creditors look at to see if you qualify for better, more preferable rates and types of loans or not so much. They will calculate your total monthly debt payments on top of your gross monthly income. So gross meaning pre-tax. Okay. And that equals your debt to income ratio.
So is that what underwriters do? Mm-hmm. So when I go get a loan and they say we're going to send it to the underwriters, do they?
Well, they're looking at this in a whole other range of things.
Okay.
And they pull your credit report to look at how often you've moved, what your job history have been. They want to know how stable of a consumer you are or not.
Gotcha.
And so how much debt you have, how much credit you have available to you, those two and many other factors play into that.
So for most of us firefighters, it's fairly simple because we came in, we didn't start earning any money until we got in, most of us, not all of us. And then we start accruing little bits of debt as time goes on. Mm-hmm. First it's a car, then it's a wedding, mm-hmm. then it's a house, mm-hmm. customarily. So mm-hmm. it's fairly simple in terms of our debt to income ratio mm-hmm. in those terms. Mm-hmm. So how do we manage that? How do we balance that? Mm-hmm.
Well, another point on debt to income is to stay between ideally 35 and 50%. And there's something called the 43% rule. So this is a helpful guideline if you're trying to figure out how to manage this. Yep. This is the guideline that lenders use to determine who they can approve for a qualified loan. And a qualified loan just means you're, fixed 30-year mortgage, nothing adjustable, nothing shady, nothing that's going to get you into potential trouble later because it's a riskier loan that you probably shouldn't be borrowing in the first place. Mm-hmm. So ideally, you want to keep your debt to income ratio below that 43%. You can see below 35% is considered healthy.
Okay.
So you really need to keep that debt that you're carrying on a month-to-month basis in check as best you can.
So the current house I'm building right now that's going to take me below that 35% threshold is not healthy.
Well, you mean to take you above that 35%?
Yeah, above that 30%.
yeah. But, hopefully your income continues to creep up. Hopefully those pay raises keep coming in.
Gotta get promoted is what you're saying.
And promotions, maybe side jobs, maybe if you're married or you have a partner, they're earning increasing income as well. And between your increasing income or dual increasing incomes, you can put good habits into place by forcing yourself through automatic savings or transfers or investments to be putting more away so that you're not tempted to overspend it because you've taken it home in your paycheck and you haven't had it automatically transferred somewhere safe. So, but we'll get more into that a little bit later on. Step 5, I say evaluate and tackle your debt. So we're talking about managing this stuff. And I mentioned that I consider debt in 2 categories, good debt, bad debt. Good debt, this is the type of debt that has lower interest rates associated with it and is considered an investment in your future. So we're talking about student loans, right? We're investing in ourselves and our betterment in our career and income earning potential in many cases. Borrowing for a home, which hopefully appreciates in value if you're in there long enough. And maybe investing in a business. Unfortunately, most businesses that we start fail, right? But maybe you get lucky and you're a, partial investor in the next tech company that blows up.
I don't know about that, but firefighters are good.
Not that I'm recommending that. Okay.
Firefighters are good at having side jobs and increasing their net worth by using their 4 days off to make more money.
That's right. So investing in your opportunities outside of your full-time job could really pay off if you're disciplined enough and you know that you should be disciplined enough to be putting that money in smart places. And we'll get more into where those places are. Bad debt, we're talking about high interest rate debt. Credit cards, the biggest one, personal loans also, those come with higher interest rates. Car loans.
So my GMC Sierra was a bad debt.
Yeah, but we're all driving cars. It's bad debt for everybody. Now, those rates were pretty low during the pandemic. So maybe some of us refinanced or we got a new car during that time and we're not paying that much in interest relatively, but that average of what the interest rate is on a car loan now has spiked just over the past few months from where it was.
Are you going to talk about that interest, or is now a good time?
That's on the next slide.
Okay, let's go into that, because that's kind of confusing to me, and I don't understand why the pandemic has such an impact on it. So maybe you can enlighten me on that.
Yeah. So there are different types of interest rates, and there are obviously different rates associated with different types of debt or savings and investments. And this is a simplified average guideline.
Okay.
So as we probably know, credit cards are the worst offender, and they come with up to 30% nowadays.
Jeez.
Top interest rates. And that would be for your borrower who does not have good credit, and they get penalized the most. Unfortunately, auto loans are hovering between 10 and 12, if not 15%, depending on how good your credit is or not. Student loans, the average between private and federal is 5.8%.
Okay.
But that, again, should be considered not so bad debt. Mortgage, current average, 3.25%. So that has creeped up since it's low during the pandemic. High yield savings, not so high yield these days. So if you're looking for where you can stash that emergency fund and earn a lot of interest, you're not going to, sorry. But you can potentially look into an online bank that doesn't have brick and mortar stores. They typically offer higher rates of interest, but right now they're offering a max of 0.5%. But it's a whole lot better than you're going to get by having it at the Wells Fargo or Bank of America savings account, which is paying 0.03%. So you can get a little bit extra in a high yield. And then an investment account, depending on what types of investments you have your money in, you can expect it to grow on average over the long term, conservatively around 5%.
You mentioned the high yield savings.
Yeah.
Where do you find those?
So if you just Google high yield savings account, you'll find a zillion websites. I usually use bankrate.com to shop around and see who's offering the highest rates of interest, not necessarily suggesting that that's the one you should choose, because it very likely will be with a bank you've never heard of. So you might feel more comfortable going with a Citibank or Capital One or Ally Bank is a popular one with my clients. Goldman Sachs now has something called Marcus, and they offer high yield accounts through that. I know those are paying around 0.5%. So if you just Google them, you can do it online. You can open an account super easily and transfer money from your regular brick and mortar bank or credit union through your checking or savings account.
Now, most firefighters, the biggest purchase they're going to make in their lifetime is a home.
Yep.
So explain to me how that mortgage moves, that percentage moves. What's it based on?
It's based on the prime rate.
Okay.
So it's based on the Federal Reserve and lots of other factors that you don't need to worry about.
Okay.
But because of the pandemic and the world being shut down and people staying put and not wanting to do anything, really because they didn't know what to do, that forced the federal government to ease lending and the distribution of cash throughout the economy to try and stimulate it.
Okay.
And bring it back. And so mortgages hit a record low at the end of last year. But now, as the world opens back up and we're in a better position to manage the pandemic, even though it's probably not ending anytime soon, but now we're learning to live with it. And hopefully the country, at least, is not in danger of shutting back down completely. Those rates are creeping back up because the feds have indicated they're going to, and they already have, increase interest rates. Okay. And so as those interest rates at the federal level rise, the lenders' rates on what they're lending increase as well. And so now is arguably the best opportune time to buy a house and borrow money from a lender. However, as you probably know, home prices are at historic highs.
So is lumber. So is the price of building materials. Yeah.
That's right. That's right. And there's this whole supply chain crisis, and that has driven inflation up. The cost of goods and services has spiked this year.
Yeah.
I show on a later slide over 5% year to date inflation when the average long-term rate has been around 2%. So we're living in a extraordinarily high, overinflated cost environment.
Right.
So we have to weigh the cost, return, benefits of borrowing more now, but spending more on what those things cost.
A lot of firefighters, including myself, have struggled with, like, for instance, I got my first bank account when I was 12, and it was at Wells Fargo. But over time, I have been told that, you know, I'm better to put my money elsewhere in a local credit establishment. What do I do?
Well, local credit unions typically offer lower rates of interest to lend money. If you're a member of the credit union, they typically offer more favorable rates for home mortgages, for car loans, for refinances. They're also a great place to shop for discounted life insurance and other types of insurance coverage potentially. But they tend to have limited brick and mortar places around where you can go in, and they typically have limited capability online. And so more and more of us prefer to do more of our banking and financial transacting online, and still a lot of the credit unions are lagging way behind the functionality of a Wells Fargo or a Bank of America.
Okay. So based on ease, it's easier to use a larger establishment, but based on percentages, if you're a member, sometimes it can be beneficial to borrow money from one of those.
And I'm a member of a local credit union in New Mexico, and I bank with Wells Fargo. So like for my day-to-day banking, I use Wells Fargo. I can do everything online and on my app on my mobile phone.
But you borrow from a credit union.
But I have my car loan through the credit union, and I ultimately will probably get my home mortgage through a credit union.
All right. That's very good information to know.
Yeah. So if you are, like many of us, struggling with debt and trying to dig yourself out of it and figure out where do you start. Here are two of the most common methods, known as the avalanche method and the snowball method. The avalanche method is going to involve paying down your highest interest rate debt first.
Credit cards.
So you make a list of all your debts, right? Maybe you have credit cards, car loans, student debt, mortgage. Your student debt and mortgage are going to be at the bottom of the list, followed by that car loan and then credit cards. And so probably you're going to want to tackle that credit card balance first. That is going to save you the most money in interest by using that method. However, it might take you longer to pay it all off versus the snowball method, where you're getting rid of the lower, smallest balances first. And then you move on to the next smallest and then the next smallest. And this can be preferable and help keep people motivated to stick with their debt payoff strategy, because you have the thrill of those balances being canceled sooner rather than having it take longer to have a balance paid off. So this creates also extra funds. If you're paying off that first debt, that second debt, now you've got extra that you can use to pay down the bigger balances more quickly, or to do some on top of the minimum payments for those and saving some at the same time. And as it says, it's a more immediate sense of progress. So it helps folks stay motivated.
All right.
So,
well, for firefighters, what's, is it personal? Like, is it depend on your particular situation on what's better, the snowball or the avalanche method?
Well, I would always recommend the avalanche method because you're going to save the most money in the long run.
If you can.
If you can.
Okay.
And however, it probably requires putting automatic payments into place to force yourself into staying on top of that plan to pay down the high interest first, so that you're not having to consciously think about it and do it when you can. It's just automatically happening. So for most of us, not just you guys, you have to really force yourself into these better financial habits by setting up as many of these pay down plans or savings plans to happen automatically so that it's out of sight, out of mind.
All right.
So if you're weighing and trying to figure out, do I pay down debt first and then save, or do I pay down some debt and save? It's a really good question. I usually recommend you do both no matter what. However, this guideline says you should lean towards paying off debt first if the debt has an interest rate higher than 7%. So that's probably going to be your car loan. It's probably going to be a personal loan or definitely a credit card. So focus on paying that first. But also do that if you live in a dual income household and you don't have dependents, because then maybe financial emergencies and unexpected expenses is not so much of a crisis in your household if you don't have people living there who depend on you. You also can focus on paying off debt if you have family or significant others to turn to in case of emergency. Some of us are more fortunate to have that than others. Lean towards growing your emergency fund and balancing paying down debt with socking something away if your debt is low interest and potentially forgivable, like a student loan under the Public Service Loan Forgiveness Program. You support dependents, you have young ones and dependents living in a single income household, or you live in a single income household and they're dependent on your income alone. And also if you don't have a sense of job security. Hopefully everyone who's listening does, but you never know. Life happens, things change.
It's a great plug for IFF Local 244, who does a great job representing all of our members in that.
There you go. So in some cases, it can make sense to aggressively pay off high interest debt and then worry about saving. But I think for most of us, starting to save something while trying to pay more on our debts is going to be the way to go.